And on today's show, Temporary Life Period, part 2 of this week's series on annuity solutions with nationally recognized annuity expert Mike McLaughlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and Innsmark. Let's get down to business. Well, welcome to the show, Mike.
Thanks.
Mike, I'm going to say I will bet a great lunch wherever you want in Phoenix, where you're here doing recording with us, that this segment is going to be new to a lot of our advisors.
Absolutely. I cannot tell you the number of times when I sit down with advisors and talk about this concept and they say, I didn't know that I could do that. So this is something that is
let's walk through it. Again, this just reminds me of yesterday's conversation on deferred income annuities. It's not new, but it's somehow got a whole new veneer and everybody's looking at it differently and it's becoming huge. Now we're talking about temporary life, period certain, and I understand period certain. I think our audience does, but this is a whole new twist. Walk me through traditional period certain and talk about temporary life period certain.
Sure. Period certain, as just its name applies, is a period certain of payments. So that if you set up your single premium immediate annuity for 10 years or 15 years or 20 years, you're going to get that stream of income for that 10, 15, or 20 years, period. You're done, okay? With a temporary life, you basically are bearing some of the longevity risk. Very much opposite of what you would typically think of buying a traditional SPIA for. So that if you buy a 10, 15, or 20-year period certain with temporary life, if you pass away before that period, then your income stops versus going for the full 10 or 15 or 20 years. So there is some risk to your estate value, but we use this in a couple different ways where you actually want to take some of the longevity risk. All
right, so let me make sure. I have a 10-year period certain. I know what I'm getting, whether I live or die, somebody's getting that money. In this scenario, maybe not, right?
Absolutely.
Now, does that increase the payouts then, or does it decrease the payout?
It increases the payouts because you're taking on the longevity risk.
Okay, so you're going to get more income, but if you die, then that's it.
Exactly.
So what's the difference between the numbers, when you've done this before, of looking at maybe a SPIA in compared to a period certain using this temporary life idea?
Well, we have a lot of different scenarios. This really works well with some of the older ages, especially when you're doing some joint things with buying life insurance and things like that. Here's a perfect example where we're having paying a life insurance premium of $9,000 on an annual basis. With your traditional 15-year period certain, let's just say that you said, hey, I'm going to prepay this thing for 15 years and using a guaranteed GUL or something like that, it's going to take you $114,000 to generate that $9,000. If you do a lifetime with a period certain, it's $134,000, which most people would vacillate to that. But when you use temporary life with 15 years, you're only having to put $100,000 in there in order to generate that same $9,000. So you're going to get $9,000 a year guaranteed for 15 years. However, if you die before then, your estate gets nothing. But if we're paying for life insurance, that's exactly what we want to do because we've reduced the estate by $100,000.
What's the comparison? Then, that being the case, what's the comparison between your temporary 15 years life? Would the discount, if I would have put this directly into the guaranteed universal life contract, would it have been more or less? Is it a better deal to go direct?
It would have been. It would be less by going this way because you're on the opposite side of the fence from the longevity standpoint. From that standpoint, and what you're doing here is you're creating leverage, just like what you're trying to do with a DIA in terms of taking care of the income and investing the difference. We're trying to push down that commitment that it takes in order to generate that $9,000 a month and utilize those assets somewhere else. Maybe we are dumping in part of that into the life insurance policy, but we're trying to create leverage, and this makes a $34,000 leverage just on one sale.
If that leverage is better than putting it directly into the policy, right? I mean, that would be a huge play.
Absolutely.
And number two, if it was marginal, you'd still want to do it.
Yeah.
So to me, this could be a dual sale here that I haven't ever thought about in this concept. Now, when you're doing temporary, you're just saying it's now becoming popular. I mean, I shouldn't say popular because everybody, to them, it's new. But this is a popular idea we want to bring to the table because it's an anomaly. And I don't think anybody's using this in their tactical planning, especially in retirement. So when we want to introduce this concept, how do I know which way to go on this, Mike? You know, I'm so used to period certain. I'm so used to single premium immediate annuity. D is, I just got over introducing myself to D as the last year. Now I have this new idea to bring in on the table. How do I do that?
I think you look at a couple different scenarios. One is we use this a lot with trying to plan with Social Security. Maybe you're trying to push out Social Security to 70 to maximize all those deferral credits, and you still want to retire at 60 or 62. Maybe you do a temporary life for 10 years. And because you're taking on the longevity risk, that ends up being that $14,000 difference. Therefore, you've created leverage in that scenario and still maximize your Social Security.
When we come back from the break, we're going to stay on this topic because I think this is a hot, even though it's an old idea, it's a hot new idea. And I want Mike to really make sure we get this because I think this could be huge in your arsenal of blocked income. It's really great. We'll be right back. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Mike, let's just redux this before we go to this example, just so we understand. Again, period certain, we all understand, 10-year, 20-year, somebody's getting that money, our beneficiary, joint, whatever. But when we're doing temporary life in a period certain scenario, we now, the customer, the policyholder or owner in this case, is taking on the risk now. So there's going to be a little bit of risk, but there might be a kind of a pop. There's going to be an increase in benefit.
Absolutely. Yep.
Now walk us through why this is so powerful. That first illustration was really great. It really helped us, but walk us through this step by step, why this is so powerful and why we should be integrating this into our practice.
Sure. This is another illustration. We put in a $500,000 premium into this particular 70-year-old male, and he's going to get a monthly payout. If you would go with 15-year certain, which is the middle one here, it's $3,352, or you choose lifetime income with 15 years certain, you're going to take about a $500 hit to $2,862. However, if you bear the investment risk, or excuse me, the longevity risk of that, and choose temporary life for 15 years, this person is going to get a payment of $3,846 guaranteed for 15 years. But if he dies before that, the payments stop. So in essence,
so there's no guaranteed period at all during that 15 period.
No, just as long as, but if he's living for the entire 15 years, he's going to get that $3,800.
He dies tomorrow?
He dies tomorrow, money's done.
So that's kind of you're adopting some of the thinking behind a single premium immediate annuity.
Yes, exactly.
Okay. So in this case, are they okay with this idea? Is a client, is a customer okay with taking on this?
I think it has to be placed in the right situation. Obviously, you wouldn't want to put the entire assets in there to boost up the rates of return, but when you think that the average person today has $65,000 of retirement assets, they've got to find ways to boost up their rates of return. So I'm not so sure that a portion of their assets shouldn't go into this to boost up their rate of return. But also think about some of the niche situations. Let's face it, this is a niche type of scenario. Think about how many people in the U.S. are getting divorced. Over half of the marriages end in divorce. And they have to pay out some type of alimony or child support for 15 years. Well, you would typically look, okay, I'm locked in at 15-year period certain, so I'm going to get $3,300. If you do temporary life, then you're going to do $2,800. Or excuse me, you're going to get $3,800. So obviously, you would, if you had to do a $3,000 a month lock-in, you're not going to take $500,000. You may only take $425,000. So you're going to create leverage in those situations where you're banking on a guarantee of income for somebody, but you don't necessarily think that they're going to live that long, or you don't want to supply guarantees past that life expectancy.
How long can I go on any of these temporary life period certains?
You can go out for 30 years, and you bring up a great point. Let's say that someone wanted to do some income planning for a 70-year-old. You may want to do a 20-year period certain to take them past life expectancy, or go all the way for 30 years and do temporary life so that if they don't live that long, then money's gone, if they're still insurable, you can replace the estate through a wealth and replacement trust, something from that aspect, and you've boosted up the income to pay for that life insurance.
And can that be single? It's only single life only?
Single life, or you can do a joint one as well.
Well, I'm just curious because when you start thinking about if I'm at age 70 and I'm willing to turn on, I know many of us have indexed annuities in our portfolio, we were going to turn on the income rider. Then we start looking at, well, SPIA rates may have went up by then. DIA rates may have went up. This might have went. I have a choice to be made here at 70. I'm not just automatically triggering my income on whatever contract I have. To me, if I'm looking at this and I'm looking at numbers, we keep adding layers of options here that are so powerful. And I'm thinking, if income is everything, do they have a COLA rider on this too? Or
yes, and what you can do that you talked about is blocking out different segments of income, placing this in the first, and then placing the DIA, and then letting your income rider really percolate to max up the full 10 or 15-year roll-up. There are different tools that, as advisors, you need to use different tools in order to get to the same goal.
Any difference in treatment of basis?
No, great question. Obviously, since it's an annuitization, there is an exclusion ratio on non-qualified money.
Even with temporary life?
Even with temporary life.
Okay, so we have to look at this now. I think now we're going to be calling, when we call the annuity team, I'm going to be saying, I need to see the SPIA, the DIA. I got to see what the income rider on the index looks like. I might want to look at temporary life with period certain, and whoever wins on that scenario, it could change weekly.
Absolutely, absolutely. Yeah, pricing changes on this on a regular basis, but again, I think that look for those niches of business owners using for buy-sell agreements, those types of things, divorce settlements, but also where you're trying to stack different income. It's a great tool.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance department. Missed an episode? You can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.